$6.2 billion in derivatives losses on a single trading book in a single office of the largest bank in the United States. 4 years earlier, in October of 2008, JPMorgan had been ordered to take $25 billion of preferred stock from the United States Treasury as a part of the TARP rescue. Jamie Dimon had said, then and ever since, that his bank had not needed the money. In a single quarter of 2012, in one office of the bank he ran, a single trading book lost $6.2 billion, 3 times the entire emergency capital injection State Street had received in the rescue of 2008. The trader at the center of it had a nickname before the public ever heard his name. The hedge funds positioned on the other side of his book called him the London Whale. His real name was Bruno Iksil, JPMorgan Chase, 2012. Inside every large bank is a department most depositors never hear about. Its job is to hedge the bank itself. JPMorgan's hedge department was called the Chief Investment Office. 2 locations, New York and London. One head, Ina Drew, a 30-year veteran who had built it from a back-office utility into one of the most powerful units inside the largest bank in the United States. The CIO's mandate was straightforward. JPMorgan held roughly $2 trillion in deposits and assets. The CIO's job was to hold offsetting positions, to take the other side of the bank's own exposures, so that whatever happened to the global economy, the bank as a whole stayed roughly flat. That was the theory. By 2011, the CIO controlled $350 billion in securities, a balance sheet larger than every American bank except 7, and it had stopped being a hedge. By December 2011, one trading book inside the CIO held $51 billion in derivatives. Run out of London, holding not bonds but credit default swaps, the same instrument that had brought down AIG 3 years earlier. A credit default swap is, in simple terms, an insurance contract on a bond. If the bond defaults, the seller pays. If it does not, the buyer pays a premium. The book was called the Synthetic Credit Portfolio. Its purpose was disaster insurance. If global credit markets collapsed, if Lehman 2008 happened again, the portfolio would pay out, offsetting losses elsewhere in the bank. Through 2007 and 2008, the portfolio worked. It paid out billions during the financial crisis, helping JPMorgan emerge stronger than its competitors. By late 2011, post-crisis spreads had narrowed. Insurance premiums were cheap. The portfolio was bleeding small, steady losses against a market that was healing. In December 2011, Jamie Dimon told Ina Drew to reduce the bank's risk-weighted assets. Drew passed the instruction to her London team. What came back would change everything. The plan was unusual. Instead of selling existing positions to reduce risk, the London team would buy opposite positions, large bets that credit conditions would improve, to neutralize the existing bets that conditions would deteriorate. The instrument they used was a credit default index called CDX IG9, a basket of insurance contracts on 125 investment-grade American companies, fixed at the composition of 2007. By February 2012, Bruno Iksil's positions in CDX IG9 had grown so large that they distorted the index itself. One JPMorgan trading book held positions worth, on paper, hundreds of billions of notional dollars, in a market that did not have the depth to absorb a single counterparty that size. Hedge funds noticed first. Boaz Weinstein at Saba Capital in New York, Andrew Feldstein at Blue Mountain, several others. They identified the opposing flow, calculated the size, and began to position against it. Across the floor of every major hedge fund, the same nickname started to circulate by January. One trader at one bank was so large his book was the market. They called him the London Whale. Inside JPMorgan, the position kept growing. Inside the hedge fund community, the trade against him kept growing. The synthetic credit portfolio lost $100 million in January, $69 million in February. By the end of March, the cumulative loss had passed $700 million. On the afternoon of Thursday, the 5th of April 2012, Bloomberg published a story under the bylines of three reporters: Stephanie Rule, Bradley Keown, and Mary Childs. Within hours, the Wall Street Journal published a parallel story under the bylines of Gregory Zuckerman and Katie Byrne. Both had spent weeks calling hedge fund desks. Both had been told the same thing: that one trader at one bank had positions in a single credit index so large the index itself was being distorted. Bloomberg led with the nickname. The Journal led with the bank. By Friday morning, every senior risk officer on Wall Street knew Bruno Iksil's name. Every credit desk in London. Every regulator in New York and Washington. Inside JPMorgan, the reaction was furious. Public exposure of a trading position is, by itself, a strategic disaster. The bank's counterparties, the hedge funds they had to trade against, now had a public confirmation of size. The position could no longer be unwound quietly. Internal emails surfaced years later in Senate testimony. Ina Drew in London the week before had ordered the team to halt new trades. The order had not been followed cleanly. The book had grown. 5 days after the stories ran, JPMorgan's first quarter earnings call was scheduled. Jamie Dimon would have to speak about it publicly. The earnings call began at 8 in the morning, New York time, on the 13th of April, 2012. Standard Q1 format: headline results, division results, analyst questions. Mike Mayo, an analyst at Credit Agricole, asked the first question about the press reports of the London position. Dimon's answer became one of the most quoted denials in Wall Street history. It's a complete tempest in a teapot. 6 words, spoken into a conference call attended by every credit research analyst on Wall Street. What Dimon did not say was that the synthetic credit portfolio had lost more than $700 million in the first quarter alone, and that the bank had just received its largest internal risk limit breach in the history of the CIO. The hedge funds on the other side, Saba, Blue Mountain, and now half a dozen others, read Dimon's quote as a signal that JPMorgan had decided not to capitulate. They piled in. The position did not unwind. Between the earnings call and the second week of May, the synthetic credit portfolio lost another $1.5 billion. On the evening of the 10th of May, Jamie Dimon convened an emergency conference call with analysts and investors. 27 days after the Tempest in a teapot remark. The new figure, $2 billion in losses, subject to further increase. Dimon on the call: this was a flawed, complex, poorly reviewed, poorly executed, and poorly monitored portfolio. The market's reaction the next morning: JPMorgan shares fell 9% in a single session, erasing approximately $15 billion of market capitalization, more than 7 times the stated loss. On the 14th of May 2012, 4 days after the emergency call, Ina Drew resigned from JPMorgan. 30 years at the bank, she forfeited roughly 2 years of compensation under the bank's clawback policy. Bruno Iksil was placed on leave. His superior in London, Javier Martín Artajo, was placed on leave. The head of the CIO International, Achilles Macris, was placed on leave. Julien Grout, the junior trader who had marked the portfolio's daily prices, was placed on leave. The Unwind itself was assigned to the bank's investment banking division, a different unit headed by a senior trader named Daniel Pinto. By the end of May, the position had cost $3 billion. By the end of June, 4.4. Final restated figure at year-end, $6.2 billion. Jamie Dimon's compensation, set by the board in January, was cut. The 2012 figure, $11.5 million, half of what he had been awarded in 2011. 2 of the 4 traders on leave, Martin Artajo and Grout, were criminally charged in 2013 by the United States with mismarking the portfolio. Bruno Iksil was never charged. Federal prosecutors granted him cooperator status. He testified against his former colleagues, returned to France, and in 2017 wrote a public letter arguing he had been given orders to execute a strategy he had warned was untenable. On the 15th of March 2013, The United States Senate Permanent Subcommittee on Investigations published a 300-page report on the trading loss. The chairman was Senator Carl Levin, the same investigator whose subcommittee had documented the bankruptcy of Enron a decade earlier. The report's conclusions were direct. The synthetic credit portfolio had operated for years with what Levin called egregious risk management failures. The portfolio's risk limits had been breached more than 300 times in the first quarter of 2012 alone. Senior management had been informed and had approved a temporary increase to the limits rather than reducing the position. A risk model used to mark the portfolio's value had been changed in January 2012 in a way that, the report found, made the portfolio appear approximately half as risky as it was. The change was implemented in an Excel spreadsheet that contained a copy-paste error. Across 2013 and 2014, JPMorgan paid approximately $920 million in fines to 4 regulators on 2 continents: the U.S. Office of the Comptroller of the Currency, the Federal Reserve, the Securities and Exchange Commission, and the United Kingdom's Financial Conduct Authority. The Volcker Rule, the provision of Dodd-Frank that banned proprietary trading at banks with insured deposits, had been delayed and watered down through 3 years of regulatory drafting. In December 2013, less than 9 months after the Senate report, the final version was adopted by 5 federal agencies, unanimously. The London whale, more than any single argument, was the reason it was. The bank that had refused, then and ever since, to admit it needed federal capital in October of 2008, lost more in 3 months of 2012 than the entire emergency injection State Street had been forced to take. Tempest in a teapot entered the Wall Street lexicon as shorthand for the gap between what a chief executive says about a crisis on day 1 and what is true on day 90. Bruno Iksil was never charged. Ina Drew never returned to banking. Jamie Dimon remained chief executive of JPMorgan for the next 13 years. The Volcker Rule passed. Proprietary trading at federally insured banks ended. JPMorgan continues to argue to this day that it never needed TARP. Next time on Empires of Money, a single number set every morning at 11 a.m. in a small London office that controlled the interest rates on $350 trillion of global debt. And the bank that admitted, weeks after the London whale broke, that it had been rigging that number for 15 years. LIBOR, Barclays, 2012.